Alright, so this is our first lecture of derivatives. And we're doing today chapter 1. Introduction. And derivatives are financial instruments used in the following two primary activities. Number one is risk management. And the second primary activity is speculation, as in financial speculation. So, what is a derivative? A derivative is a financial instrument. Derivative is a financial instrument which derives its value from another asset. So, it is a financial instrument which derives its value from another asset. What is a financial instrument? Financial instrument, sometimes we call it for short, instrument. But it is best known in finance as, let me put it in red, security. As a security. Okay. And it is also known as financial assets. Next, to define financial asset, we need also the other type of asset known as real assets. And you need to differentiate between the two. Real asset is an asset which has its own intrinsic value, which is valuable for itself. These are real assets, like table, like tea, okay, like water, okay, like gold, right, like rice. These are all real assets, okay? They have a value of their own. Their own value we call intrinsic. Now we need someone with a dictionary who's got already the little dictionary. Translate intrinsic to Thai. Who's the translation man today?
I can do it.
Huh?
I can do it.
Okay, what's intrinsic? To everybody? Champ, what's intrinsic? Intrinsic means of its own, of itself. Come on, guys. All right. So, real assets have intrinsic value, while financial asset is a claim. Financial asset is a claim on someone else's assets. Okay? And financial asset could be a claim on another financial asset. Okay? So, financial asset is a claim. And now, we'll do the next important thing, which is, we do here primary asset classes. Now we're going to classify, cameraman. All right, zoom in a little, right? Yeah, where's the other guy? You go there and watch him, okay? Sit there next to him. You just sit there next to him. Primary asset classes are, and then we have secondary. Secondary asset classes. So, you have already studied them. Which are the five primary or main asset classes in finance? Which are they? 5 asset classes. Which one have you studied? You never studied assets, have you? Which are the main asset classes? All right, I'll begin. Number 1, stocks. Next one. Bond. Next one. Bonds. Next one. Gold. Okay. And silver. And oil. Don't forget, it's lunchtime. Rice. How we call these? Commodities. Two more. What else?
Currency.
Currency. Perfect answer. Number 3 or number 5? Number 3 or number 5 I put currency. Why 5? Okay, what's the other last class? So, we got 4 out of 5. What's number 5? Everyone in Thailand today crazy about investing in it. Everybody investing, everybody throwing millions of baht to invest in it. Real estate. Oh. So these are the 5 asset classes. Now, where do I put real estate and where do I put currency and why? If I put in stocks and bonds, here comes currency, number 3. Okay? And here come real estate. Okay. Now, why I put currency here and real estate here is simple. These 3 are financial. Financial assets. Okay, take a look now. Remember how I wrote here that assets are classified into financial and real. The main financial assets are stocks, bonds, and currencies. And the real assets are commodities and real estate. These are real assets. Okay? Is this so far clear? Is it clear? Now I move on here. The secondary asset classes are usually derivatives of the primary. Now, for stocks, I'll put in a little arrow here. We call the derivative of stocks stock derivatives. Stock derivatives. And possibly stock index derivative. So a stock derivative is a derivative whose value depends on a particular stock. A stock index derivative is a derivative whose value depends on a particular stock index, like Dow Jones, like NASDAQ, or SET, right? Okay, stock index derivative. Is that fairly clear? Next, bonds. Bonds have a derivative. How we call bond derivatives? Bonds in finance, huh? No. In bonds, we call in finance fixed income securities, and these become fixed income derivatives. So these are derivatives based on bonds, whose value derives from bonds. Next one. Derivatives based on currency, we simply call currency derivatives. Currency derivatives. They depend on the value of a particular currency. And that's actually not true. They don't depend on the value of a currency. They depend on the value of an exchange rate. A value of an exchange rate. Now, I'm going to switch back over here to make sure everybody understands exchange rate. What is an exchange rate? Exchange rate.
US dollar.
Okay, US dollar.
And Thai baht yen.
Thai baht yen. Exchange rate.
Trade off the rate.
Oh, we have a different way of saying. An exchange rate is a ratio of two currency. A ratio of USD to Thai baht. It is a ratio of euro to yen. Yen we usually write as JPY. Y. So, an exchange rate is the ratio between two currencies. Okay? And currency derivatives are derivatives that derive their value from a particular exchange rate. Okay? Exchange rate. And the exchange rate is one measure of the value of a currency. Okay? All right. Next one we call derivatives that derive their value from commodities. We call commodity derivatives. Commodity derivatives. Which happen to be very well developed in Thailand because Thailand is a major producer and exporter of commodities, okay, of certain number of important, globally important commodities. And finally, what do we do with real estate? That's a little trickier. With real estate, you got an intermediate financial instrument based on real estate. How we call that instrument? It is, again, it is fixed income. It is a loan, but it's based on real estate. How do we call it?
Mortgage.
Again?
Mortgage.
Mortgage. Yes, mortgage. So, a mortgage is a loan secured by real estate. Let me emphasize, because students are confused and bankers don't understand. A mortgage is not a loan for the purchase of real estate. It's not a loan to buy real estate. A mortgage is a loan secured by real estate. You can take a loan, secure it with your house to buy a car. You can, take a loan to go on vacation. Any loan for any purpose secured by real estate is called a mortgage. That's the name of the meaning of mortgage. Now, most commonly, about 95% of mortgage loans are used for the purchase of real estate. And 95% of them are secured with the purchased real estate. But there is no problem for you to have apartment A. You own it, it's yours. And you take a mortgage of A to buy B. So, you got now two properties with a mortgage on A for the purchase of B. Now, you can use and mortgage property B to buy C, okay? And then use C to buy D, okay? So, you see how mortgage of one property could be used to buy a second, and then a third, okay? And this is called leverage on top of leverage on top of leverage, okay? You're building a pyramid, right? Okay, so back to real estate. The financial instrument is called mortgage, And the respective derivatives are called mortgage derivatives. Mortgage derivatives. Okay? And sometimes, but it is not correct, I'll explain in a minute, we call them credit derivatives. And credit derivatives are derivatives that base their value on loans. So, what could be the loans of a credit derivative? The loans could be, number one, I wrote it, mortgages. Number two, car loans. Number three, student. And all sorts of other loans. So, as long as it's a loan behind it, it becomes credit derivatives. Okay? And it can further go in, I'm not going to get into that now, I'm just giving you a quick overview. It can go into credit default swaps. We'll cover them late in the fixed income course, okay? Credit default swaps. So, these are the primary asset classes, and these are the secondary asset classes. Now, we get to the concept of underlying. And underlying in derivatives usually stands short for an underlying asset. An underlying asset is the asset on which the derivative derives its value. So, the underlying asset of a stock derivative is the stock. The underlying asset of a stock index derivative is the stock index. The underlying asset of fixed income derivatives are bonds. The underlying asset of currency derivatives are exchange rates. Okay, exchange rates, or an exchange rate index like the US dollar index, but the index itself is based on exchange rates. The underlying of commodity derivatives will be a commodity, or let me write it here, commodity index. You may have energy commodity index of oil, natural gas, and so on. You may have agricultural commodity index. Okay. You may have metals commodity index. You may have precious metals index like gold, silver, platinum, palladium, or base metal. So you may have different commodities or commodity indices that will be underlying. And finally, with credit derivatives, the underlying is a loan. Car loan, student loan, mortgage loan, some type of a loan, okay? If it's a mortgage loan, will be itself based on a real estate, okay? And finally, it's important to understand these are called secondary asset classes. I don't have the time, we call it tertiary. Tertiary means it will be a derivative on the derivative itself. So you have a stock derivative, now I have a derivative on the derivative. Okay? For example, you got a commodity derivative. And the commodity derivative, let's say it's going to be gold, is going to be a gold futures. And then the tertiary will be an option on the gold futures. Or you're going to have a credit derivative. And you will have a swap on the credit derivative called credit default swap. Okay? So there is no problem to have a derivative of a derivative. Okay. This is called second degree derivative. And there is no problem to have a derivative of a derivative of a derivative. Okay? So you can chain them up. Okay? So this is the primary and this is the secondary that you need to understand. And next one will be types of derivatives. Let's see. I covered derivatives in here. Okay. Real, financial. Okay. Yeah. Derivative types. The first, most important, most fundamental to finance is the options. An option gives the buyer the right, but not the obligation to buy or sell a particular asset. We call it a particular underlying. What else? At a given price for a given period of time. Okay? So, it's number one. It's a right. Number two, you can buy or sell. Number three, for a given price. And number four, a given period of time. Okay? Is it clear so far? How do we call the buy and how do we call the sell? The buy we call a call. And the sell we call a put. How do we call the given price? The strike. Or this stands short for strike price. We can use strike or we can use strike price. Okay, up to you. And the time period we call, somebody there? Yeah, again. Loud. Maturity. Maturity. We usually use it for bonds or other fixed income. Maturity is a time where a security becomes due. Okay? In this particular case, it's the validity of the option. It gives you the time for which you have the right to buy or sell at the given strike price. Okay? And next is a forward. And forwards usually go together with futures. And forward is a contract today to buy or sell a particular underlying asset at a given price at a given moment in the future. So, the option represents the right but not the obligation. Here, it is obligation for both parties. Both parties agree they will exchange on a given date for a given price. And then we have one more piece if it's a commodity, given quality, like rice. I mean, it's got to be certain quality. And of course, if it's a commodity, place, as in delivery. Where? Is it going to be in Bangkok, in Phuket? Where? Okay. So, the forward gives you this. And now, a futures. And the futures is, the key word is standardized. Standardized forward. Standardized will mean the following. Let's say it's rice. It's going to be 10 tons. Okay? So, one futures contract will be 10 tons of rice of certain B plus quality delivered in a warehouse in Bangkok. Okay? So, standardized means it tells you what's the size, it tells you the quality, specifies the size, specifies the quality, okay? It specifies the delivery location. It gives you standard specifications, okay? Now, forward, the right to buy and the right to sell, how we call them? If you have the right to buy, how do we call that? Forward. Long. It's called long. So, a long is a forward or futures contract giving you the right to buy. And the right to, or sorry, the obligation, my mistake, the obligation to buy. And here is the obligation to sell is short. Sometimes the given date is called the delivery date. Delivery date. And the price is still the strike price, still the price, okay, the futures price, forward price. Okay, is it fairly clear? Let me see if I got anything else. Yes. Forwards are non-standardized. They are custom made and they are traded over the counter. Okay, so now I gotta move over here to introduce financial markets. Financial markets are of two types. Number one, over the counter. And number two, exchange. We like to call it organized exchange. Over the counter is the market where two private parties, either two people or a person in a business, or two businesses, could be two financial institutions or a corporation and a financial institution. So where two parties agree on something, where two parties trade a financial instrument. Okay? And organized exchange is actually an institution itself, which is set up for the purpose of trading particular assets, particular financial instruments. So, over the counter, forwards are traded over the counter, usually between banks and corporations. And futures are traded on organized exchanges. Okay? We also have a subclass over here, which is futures is a standardized. You can have options on futures. Options. On futures. So this is an option, gives you the right to buy or sell the futures contract. And then the futures contract gives you the obligation to do whatever you want it to do. So you have options on futures. And number one, number two, number three, let's make sure I got it right, is swaps. Swaps and other derivatives. Swaps. Swaps. A swap is a contract to exchange cash flows or to exchange different instruments. Okay? So, a swap is a contract where you're going to exchange cash flows. I don't want to get too much into swaps, because we're going to have a special week to study it later on in another course, okay? This course will focus on options, on futures, and possibly on options and futures. And some of the other stuff we'll cover, like credit derivatives, you'll be covering in either fixed income securities or we'll do in risk management. This makes the course a little easier on you, okay, to simplify. So most of this course will be options and futures, okay. The first half, mostly options. The second half, futures, and a few other little things at the end. Is it fairly clear so far? Is it time for a break or not yet? All right, 10-minute break. Camera.